You've spent the last 2 years pushing your credit score to 780, and it might be the least important number in your whole mortgage approval. Here's the one lenders actually use to decide if you can buy that home in the greater San Francisco Bay Area. Your credit score and your debt to income ratio answer two different questions. Your score is about the past, how reliably you've repaid what you've borrowed. Your debt to income ratio, or DTI, is about right now. Given everything you already owe, can you carry the new mortgage? Only the second one is about full affordability talk. And affordability is exactly what a Bay Area house price tag will test. If your plan to buy a home rests on your credit score, here's news as of November 2025. Fannie Mae dropped its old 620 minimum on loans through its automated system, and Freddie Mac followed suit. For years, a 619 score meant an automatic no. Now the system will read your whole file instead of rejecting you just over one number. Now, your score still will set your interest rate, but it rarely now sets your approval. A 760 and a 700 score with the same file both get a yes. The 760 just pays less for it. Now, when a lender asks about your DTI, here's what they mean. You add up every required monthly debt payment you have, the mortgage you want, the car, the student loans, the card minimums. You divide that by your gross monthly income before taxes, and that percentage is the number the underwriter is really testing for. For a standard conforming loan, the ceiling sits around 45%, although we've seen it push to 49%. Here's what it actually takes to buy a $1.5 million home in the East Bay. 20% down is a $1.2 million loan, and at today's rates, your full monthly principal, interest, property tax, and insurance lands you around $9,300 a month. Now you add your normal car, student loan, and your credit card bills, and you're near $10,500 a month. Now, to get approved at 45%, for that ceiling, you need to earn about $281,000 a year. To actually live comfortably, you're probably wanting to make at least $350,000 a year. That gap is the whole story. The lender might say yes at 281, but your comfort may not start at 350. If you borrow to that ceiling and you are pre-approved on paper, you could be really stretched in real life, especially when your property taxes and insurance starts to go up after the first year. Here's the part that can catch East Bay buyers above 1.2 million. There's a line called the conforming loan limit, and in 2026 in Alameda and Contra Costa counties, it's about $1.25 million loan size. You stay under that, and you keep the friendlier underwriting rules. You cross over, and now you're in jumbo territory. The rules get stricter, not looser. Now, jumbo lenders will cap that debt to income ratio, or DTI, closer to 43%, and they want a 700 plus credit score. They also mostly require that you put at least 20% down. So you can walk in there with your 800 score and get stopped cold at 47% and still not buy the house you want. The number you were so proud of, that credit score, really did nothing for the constraint that ended up really mattering. Move-out buyers get stuck here a lot. When you buy your next home before selling your current home, you can only briefly carry those two mortgage payments. That doubled cost can push your debt to income ratio past what a lender is going to allow, even with great credit and strong income. A pristine score, real income, and you still get a no. The fix is timing, and it's definitely worth planning before you make that offer. This is an area where we specialize in, so reach out to us if this is you. Now, here's the fastest way to qualify for more home, and it has nothing to do with your credit score. Your debt to income ratio is actually a number you can move fast. You pay down some credit cards, you pay down your car loan, and your ratio will drop very quickly because lenders will recalculate that when they underwrite your file. Now, you can't move your credit score that fast. A temporary interest rate buy down, the kind that sellers will fund sometimes, will lower your qualifying payment too. But there's a catch. A temporary buy down won't really help you qualify because the lender will still qualify you at the full rate because that rate's not permanent. It resets to higher in 2 years. Now, if you're buying a home in the Bay Area this year, run your DTI calculation before you fall for that home. We have published a full framework in our Forever Home Playbook, which is linked below. Feel free to grab your free copy.